Thank you for joining the Natural Capital Declaration webinar in March. This is the second webinar this month, and today we'll be hearing from an NCD signatory, NCD supporter, and some also from Fabian Huwyler at Credit Suisse, who's been doing some innovative work on conservation finance. I'm Liesel van Ast, I'm Program Manager of the Natural Capital Declaration. We'll also be hearing from Andrew Mitchell, who's Co-Director of the NCD, and from Giorgio Capurri at UniCredit, who is the Chair of Working Group 1 on Understanding Natural Capital, and from Dom Smith from RMS, who's working with us on a project on drought risk. And we'll be hearing from Vanessa Evans from Fauna & Flora International, who's been managing an NCD scoping study on green finance opportunities. So I'll hand over now to Andrew Mitchell. Andrew, go ahead, please. Sorry, you're unmuted. You're unmuted now.
Did you mute? I'm okay. Can you all hear me now, I hope?
Yes, we can hear you.
Great. So I'm the co-director of NCD and the founder of the Global Canopy Program, which is an NGO based in Oxford. And the Global Canopy Program and UNFFI share the management of the Natural Capital Declaration, which, just to remind you, was launched at the Rio conference, the Earth Summit in 2012. We had a high-level launch there, and then following that we spent a year putting together a governance structure, which you see before you in the slide, and a detailed business plan, and then we had to raise the funding that is necessary to move the Natural Capital Declaration forward globally. And that funding has now come in from the Swiss government, SECO, which is the Economic Cooperation Division, and also from the German government, from the Economics Division of the German government, being funded through GIZ, also the American Foundation, the Moore, Gordon and Betty Moore Foundation have also assisted, and we have some other irons in the fire. Liesel will talk a bit more about that in a moment. But this means that the structure in front of you can now really start moving ahead, which is really exciting. So just to talk about how we govern ourselves, we have a steering committee which was formerly chaired by Bill Rahill of the World Bank, head of environment at the World Bank, and he was succeeded in January this year by Namita Vikas from Yes Bank. She's head of sustainability there. Yes Bank is about the fourth largest bank in India. And I was in India just last week and had a meeting with Yes Bank and with other Indian banks, because we're interested in trying to get more Indian banks to join. So I was in Mumbai and had meetings with a number of Indian banks, and we're hoping to have a meeting with the Indian Banking Association later on this year, probably in May, where we hope to get interest there in the work of the Natural Capital Declaration. So on the steering committee, it's composed of the signatories to the declaration. That's CEO or C-level sign-off, financial institutions. A selection of those are on board, including the working group chairs that you can see at the bottom of that box, and the vice chairs. We also have representatives from the supporters from civil society organizations like IUCN, the World Wildlife Fund. And of course, we also have Ivo Mulder, who was the instigator of the Natural Capital Declaration at UNFFI many years ago. And Ivo continues to provide advice at the steering committee level. The Secretariat, as I've said, is UNFFI and GCP. We're informed by an advisory network drawn from experts around the world that we can test our ideas against. And then the key thing is the 4 working groups. The first one, Working Group 1, on understanding what natural capital means for financial institutions. Working Group 2, which is how you begin to embed it in your processes and products. And Working Group 3, which is looking at how this could be accounted for in real numbers. That one we're not yet really fully running, but we're hoping to get that going later this year. And Working Group 4, which is on reporting and disclosure. Now, each one of those is chaired by a bank. You can see Giorgio Capurri from UniCredit, Marcos Mancini from Banorte in Mexico, Rosemary Bissett from National Australia Bank, and Kirsten Simpson from Vic Super. And there are also vice chairs that you can see below them. These rotate, well, sometimes people have to drop out anyway, and they're replaced from the signatories. And under each of these working groups, there are projects, and different signatories to the declaration participate in the projects. That's mainly banks, but also insurers and investors who say that is an interesting project, I want to participate. And what does participate mean? It means that you have a hand in developing the projects, the design of the projects, and you test the projects inside your own institution. That requires a few days of time from some of your staff, and then you feed back the information on how that project might work in your institution, how it might be changed back into the system. So as the project unfolds, it gets better and better by testing by those people who signed up to that project. And there are a number of these now getting underway on stress testing for banks, on water risk, some tools already launched, which Liesel will tell you about in a minute. So that's the process through which you can get involved. It's also possible for those who have not signed up to the declaration. We want to encourage other people to come in, other institutions to come in, and they can participate under the rules we've agreed in one project. That is a way to get people involved. Sometimes we know how difficult it is to get CEO or C-level sign-off. So it's a way for them to find out what it's all about, if they like it. If they want to involve themselves in another project, then really we want them to become a full signatory like the rest and be fully engaged. So that's broadly the process, and I'll hand it back to Liesel. Happy to take any questions if there are any at this stage. Back to you, Liesel.
Thank you, Andrew. So if you have any questions, if you raise your hand or if you pop a question through the chat box or the question box, then we can either answer them now or we can come back to that later. We'll also have time for questions later on in the webinar. So I'll just run through some of the progress we made during 2015. We raised around $5 million to implement projects over the next 2 years. So these are the initial projects that we've funded and mostly through governments and foundations, and completed last year to build capacity really under Working Group 2, which is around embedding natural capital into financial products and services. So the first tool that we developed was around soft commodity forest risk assessments, and that we developed together with 10 NCD signatories who gave us a behind-the-scenes look at their policy implementation and development so that we could see how they were monitoring and implementing policies around soft commodities, which we focused on beef, palm oil and soy. So the tool itself is on the website, and all of these tools can be downloaded. They're open source, and this one is really for benchmarking policies to help see ways in which they could potentially be strengthened to make sure that they are in line with market developments, with companies making zero deforestation commitments and shifting to sustainable commodity production, and also in line with the latest science around high conservation value forests, for example. The second tool and the next two tools were both on water risk. The first one focused on corporate bonds, as you know, under-researched area generally on environmental ESG issues. And this one is looking at the mining, power and beverages sectors, and it's really for a bottom-up assessment of companies looking at their assets and how exposed they are to water stress. So it's for benchmarking companies on water stress. I'll come back to it in a minute to all of these tools and give a bit more detail. But that was developed with 7 financial institutions, and so banks and investors. And the third one was done with Bloomberg, and that's more for equity investors, and it looks at copper and gold mining companies' exposure to water stress. And this one, Bloomberg developed it technically within the ESG team, and we helped them to design the tool and work on a white paper which explains the underlying methodology and relevance of water stress for mining companies. So several financial institutions, investors and banks took part in workshops in New York, London and Washington, which was a chance for us to also get feedback during the tool's development. And NCD signatories and other financial institutions taking part is really key for making sure that these tools are actually usable and add value and can be integrated by finance professionals. So the first tool on soft commodity forest risk assessment was, it was developed with Sustainalytics and also with input from WWF. And it looks at three main areas. There's the scope of policies, whether they cover the whole value chains of companies they're investing in or lending to, or whether it also covers all of the financial instruments of the institution that are relevant for soft commodities. And for policy strength, we look at the criteria that are in the policies around environmental, social issues, and also whether they are considering certification of sustainable commodities production. This is all to address deforestation risk that can be embedded in these supply chains through, for example, consumer goods companies' supply chains. And the third part, which is assessed through the tool, is around implementation, monitoring and reporting. So this looks at product development to support the transition to sustainable commodities production. Only a handful of financial institutions actually had anything concrete on that, so there's definitely a lot of, although there was a lot of interest in that area, there's still a lot of scope for making advances in that space, both on the demand side that companies really need the finance to make the transition, and also, of course, it's a potential growth market for banks and investors. The implementation side, we looked at companies' policies, or how they're actually assessing internal compliance with the policies, as well as how they're assessing whether companies are complying with the criteria that they're setting out when they're providing finance. So those are the main areas for which the tool uses scores to assess banks and investors' performance on these areas. So the results show that there were 30 financial institutions assessed overall, and the results showed quite a wide variation in their strength of their policies and the scope and implementation mechanisms. So this shows that there's a real wide variation in exposure to deforestation. At the bottom you have zero there, which is a financial institution that didn't disclose anything on policies around environmental social risk in this area, and it's actually based in a tropical forest country, and generally we found that several of the multinational or international financial institutions had stronger policies than some of the national institutions in tropical forest countries. So there's a lot of room for improvement, and you could see that the areas where some are really strong would mean that they would then be less exposed to deforestation risk, which means less exposed to potential reputational and regulatory and financial risks that can result from deforestation. So we published a report alongside the tool, which has more about the findings, the methodology and the criteria. So it can be used by banks and investors so that they can assess their own policies, see how they score in the different areas, and of course then they can test any changes to their policies on how much that would improve their overall positioning relative to their peers. Around 1,000 institutions have downloaded the report or tool, and we've heard anecdotally that some have already updated their policies during the review of deforestation policies, and we'll be running a survey to collect more information and case studies about how this is actually being used in making a difference and how it's helping to make a difference in practice. The second tool for corporate bonds, as I said, that we had 7 financial institutions take part, and we also had an expert council with a wide range of experts to provide independent input on areas of water stress and also other water risk tools to make sure that we're building on what's already out there, and we're aligning indicators with, for example, it uses the World Resources Institute aqueduct data and their water stress factors. So this is helping to make sure that there is consistency and alignment generally across the way that we're looking at water risk. So what we did is take the water data from aqueduct, calculate the shadow price for the value of water, which is the external value of water to other users in these regions, to see how high the value would be in areas of water stress and what the value would be where water is abundant. So of course it would be much higher in places of water stress, and this helps to then translate the water stress factor into a financial factor which can then be applied to the company's own water use, so that we could then derive a company-specific shadow water price. This means that a company that's got a high shadow water price for its water use is therefore using water in water stress areas, and this is a way to then put the company water use into context of the locations where they're sourcing water from and where they're depending on access to supplies for their production. So we're focused only on production, not on supply chains in this analysis. And by applying this water stress price to the company's water use, we could then look at how this could wrap up into their financials. And we plugged it into a standard credit risk assessment by inserting it as an additional OPEX cost. Not to say that the companies will pay this additional water price, but as a proxy for their exposure to water risk. And so this is a way of looking at the impact on traditional indicators used by ratings agencies, so that we looked at, for example, the impact on leverage ratios to see how the company's potential credit rating might be affected by internalizing the costs of water stress. And this could happen through loss of social license to operate, higher water price, higher CapEx or OPEX costs, or otherwise, of course, change water restrictions and changes in their water rights. So the shadow water price is a key part of how we, in this particular tool, how we interpreted water stress and applied it within the financials. And this just gives you a bit of a visual of how in Beijing, for example, the value of water is around $14 per cubic meter, to reflect the big water pressure there given the supply demand. Population adjustments were made to the water value so that we could take account of increased competition for water resources in certain areas. So it's not just looking at water supply, but water demand as well. So far, the financial institutions that took part in the project showed how they have come back to us and how they could use it for corporate due diligence, portfolio reviews, engagement, and product development. So again, we'll be doing a survey to find out more about the actual applications and use of these tools to see how they're supporting strengthening of risk management, and also opportunity development with potential development of corporate bonds based around water, similar to water equity funds. So the water stress value, the shadow water price, was also used in this tool, which is available on the Bloomberg terminal. And we'll also be developing an open source version of this tool, which will have all of the functionality of the tool on Bloomberg, but not the Bloomberg data. So it could still be used as long as financial institutions plug in the corporate data. So what it needs is the mine level production data, which is then adjusted for the water stress at the locations where the companies are extracting gold or copper. And then this is a way of then integrating it into the adjusted company revenues and the potential share price. So the tool itself also has projected water stress, so it's also giving a forward-looking view of potential exposure to increased water stress in the locations where companies operate. This is based on the Intergovernmental Panel on Climate Change data on potential climate change impacts. And so it's not just based, so it's showing you that although companies may have had availability of water in the past for production, their reserves and their future production may not be as have as secure supplies. But it's very much based on the evidence base. So some companies were less exposed than others, and so it's a way of benchmarking companies on their exposure to water stress. Of course, if they were all the same, they could potentially all pass through the costs in their cost of goods. But because there's a variation, that means that there would be variance in their risk exposure. So the tool offers different options for assessing risk. One is that you can assume that they reduce production in line with the level of reduction in water availability, and then you can see the potential stranding of assets can be wrapped up across the company into potential impact on share price. The adjustments can be made so you may assume that there's less of a direct correlation between a fall in water availability and a fall in production. And then you could also add in change additional assumptions, so it's very flexible so the user can make their own assumptions. The second option that can be selected is to invest in CapEx. So you could assume, for example, the mining company invests in desalination plant to secure water supplies if they're by the coast. It could also be adjusted, so if you know they've already done this, you could adjust their you can adjust for the expenditure and reduce their exposure to future capex costs. And then the third option is to include the shadow price of water, so we're not presuming how they might internalize these costs, but just showing the relative exposure to water stress across their operations. So we'll be building on these quantitative tools over the next few years in the projects that we've raised the 5 million for. And the first one is advancing environmental risk management in lending investment, and it's looking at all natural resource and environmental issues. The second one is on drought stress testing for banks. So that project is already underway, and we have 9 financial institutions taking part in it. And the first project, we're still inviting financial institutions to join, and we'll be getting started in the next few months. But now I'll hand over to Giorgio Capurri from UniCredit, who will tell you more about the environmental risk management project. Thanks, Giorgio. Go ahead.
Hi, thank you very much, Liesel. So the project, as Lisa said, is to advance environmental risk management. Basically, it will be about mapping natural resource risks and trying to find the methodology to integrate those considerations into credit risk assessment. It will be a global analysis with a focus on some countries like Peru, Colombia, and South Africa, and Indonesia. And the asset classes will be decided by project partners for the 2 work streams that we will see later. The partner is the Swiss State Secretariat for Economic Affairs, the SECO, who funded the project. So we see 3 steps here. The first is to develop a business case for natural capital risk for financial institutions, and then they identified adequate methodologies to map them across the portfolio of all the financial institutions, and then to develop the approaches to integrate those into the credit risk assessment. The structure of the project is very simple. It's a 2-phase project. The first will be developing and testing the methodology, and then the second phase will be to develop the guidance for embedding those into the risk framework. According to the structure of the quality of the partners, we will have 2 work streams separates, one for commercial banks and development financial institutions, and the other one for investors. Next slide, please. Okay, we started the activity under this project, which encompasses Working Group 1 and Working Group 2 of the Natural Capital Declaration, with publishing in 2015 of a scoping study in which we tried to find first a business case on the relevance of risks, and then the assessment of what is today the global knowledge, either to evaluate the current state approaches and to fill the gaps identified. We ran a survey across 36 respondents, I mean across many others, but 36 respondents, and here we show the actual results of that. As you can see, there is a high percentage of institutions which are monitoring risk at transaction level. I suspect that this is related to greater principles. But by the way, among those 36, there is already given understanding of the relevance of the topic, so that almost 50% are incorporating into credit risk, and more than that are reporting publicly, and even more reporting internally. Okay, so then the other activity, of course, when we were trying to understand the state of the art, there was also the need to understand the capability of research providers, and the assessment methodology was made on the basis of a number of elements, like the quality of the underlying research processes, the accuracies in the definition for natural capital, which, as you know, has there are several of them out there, and the adaptability of methods for the banking and investment sector, which are the main player, the breadth, depth, and originality of the data sets used as inputs, then the quality issues in the methodology, and the methodological approach to disclosure-based and non-disclosure patterns of companies. Finally, we assessed the ability of the methodology to demonstrate materiality in financial terms, sorry, and the adaptability of that methodology to specific issues, and of course the scalability of the methodological approach which are proposed. And finally, the resource effectiveness of the methodological approach. Based on that, we surveyed and we saw that a large portion of those had methodological and quantitative capabilities, to a lesser extent only methodological and only quantitative capabilities. Next, please. And then we assessed their capabilities in terms of specific issues. As we see from the graph here, GHG emission, as expected, is the largest identified capabilities because the methodology is widespread and shared among many institutions, and water risk is also another high level capability detected among the organizations which were surveyed, and to a lesser extent forestry and agricultural produce and over-exploitation risks. This next slide. Now, the project structure is divided into several components. So the first component is the scoping study, which has already delivered the output that I just mentioned. Component 2 is the development of a shared approach and methodology for capital risk and mapping, and has an output, will have a draft methodology ready to be tested by participating financial institutions. The other component is to test the shared methodology by the participating financial institutions, and will have as an output the mapping of risk associated with the impacts and dependencies. There will be a confidential report for participating FIs, because we will be still in the first phase. Then the fourth component is to share and aggregate the analysis outcomes of the mapping exercise, including building the business case for materiality of natural capital risk. Here we will have as an output an interim note on lesson learned from the exercise and the business case why the client's impact and dependency are a risk for financial institutions. Component 5 will be the development of the final natural capital risk mapping methodology, and there will be a final methodology which will be open for consultation and peer review. Component 6 will be the aggregation of all the results into a final output, and then the final output will be the publication of mapping impacts and dependencies, including methodology, guidance, business case, and recommendation. In phase 2, then we will have 4 more components. The first is the scoping study and the feasibility assessment, which will be based on the approaches already available and the practices for embedding natural capital consideration in investment risk analysis for different asset classes. And we'll have as an output a short interim report on the existing approaches and the best practices available. Then the second component will be to link the natural capital risk to credit and investment risks by developing a framework of core indicators for natural capital risk as better reviewed by financial institutions. As an output, we'll have a system of indicators and corresponding industry, asset class, geography benchmarks. As I said before, the asset classes will be decided over the course of the exercise according to the NCD view something to be defined here. The third component will be to analyze the current credit risk assessment models by asset class. So developing first the initial approach and recommendations to embed the natural capital into credit risk analysis and optional testing by participating FI, which can test over time on their own portfolio, the first methodology available. The output of this component will be an interim note to be discussed by the financial institutions, and the result analysis and the approach will be accompanied by a set of recommendation and guidance. Finally, the fourth component is to develop the final methodology to embed natural capital consideration into credit risk analysis, with potential recommendation to design the risk-adjusted premium for clients, which is the ultimate goal. That component will have two deliverables, which are the final methodology and recommendations, and then the final report, which will include all the approaches and newly developed common methodologies and recommendations. Next, so as briefly quoted by Andrew before, we have several options to participate for all financial institutions interested. First is to participate as project partner, so participate in project research and development and test the drafting methodologies and tools in the selected asset classes. There is an option to participate as a technical advisor, so that the organization can provide inputs and methodologies to development as member of technical advisory panel. And finally, there is also a stakeholder group to be updated and consulted on the methodology and developments found over the course of the project.
Thanks very much, Giorgio. So if anyone has any questions, you can just put it through the chat box or the question box or raise your hand. Otherwise, just to say that the project partners will be nominated as workstream leaders of the investor or banking workstream. So we still have some, over the next few months we'll be identifying who will be leading which workstream, and we're also working on the specification so that we can put together a consortium of academia and consultancies and experts in this relevant areas so that we can implement from late summer onwards. So we'll now go on to the next NCD project, which we'll be doing over this year. Sorry, this will be... Dom, I'll need to just get the slides up for you. So hang on a second. I'll just change the presentation. Hold on. So while I do that, I'll just introduce the project. It's together with GIZ, and it's a project which is looking at drought stress testing in 5 countries, Mexico, Brazil, the US, and China and India. And we've set it up with 9 financial institutions which will be working with us on testing the tool that will be developed over the coming months. And we've appointed RMS. We're appointing RMS to work with us on developing the modelling. And this is because they have vast experience from the reinsurance industry, which we're looking at how to bring that into banking for stress testing. As you may know, the UNEP inquiry has been raising stress testing on the agenda for some time now, and this is a practical way of trying to advance capabilities in that area. Dom, go ahead, please.
Thanks, Liesel. Good morning, everyone. So I'll take the next 10 or so minutes to introduce the work developing the stress testing tool for banks to perform drought or severe drought analysis on their commercial loan portfolios. Now, given that such an effort connecting a meteorological model to a whole portfolio of loans, sorry, I think the presentation has just changed. There we go.
Sorry, I was trying to hand it over.
Yeah,
I'll hand it over to you now.
Great, thanks. Okay, so given that such an effort connecting a meteorological model to a whole bank portfolio and trying to calculate an expected loss from that is quite a sort of novel thing to do. The team that we've assembled, the project team has assembled, comprising the partner banks, academic and industry experts, and also the project team and ourselves, is sort of put together with multidisciplinary approach to try and make sure that we've got all the right knowledge in respect of stress testing for banks and the right knowledge in respect of the actual hazard that drought presents, being the meteorological and the engineering and the economic impacts of it, to be able to produce something that is useful to not just the partner banks that are on this project, but also any other bank that has commercial loans in the regions that we're talking about. And these regions do represent a very large proportion of global GDP, so we expect it to be a pretty comprehensive way of looking at stress testing on a scenario basis. For those of you that don't know RMS, we've been in the financial sector for quite a few years, since the 1980s, looking at granular methods for modeling the impact of natural hazards to portfolios. But in the typical case, we'd be looking at insurance and reinsurance portfolios. There's a lot of work that's been done in stress testing in that field, both for internal and regulatory use, and we're looking to make use of that in the work that we do in this project. Next slide. Okay, so just to talk a little bit about stress testing and what we mean by doing a stress test to a loan portfolio from an environmental standpoint. Here, I'm thinking about a drought and how that could apply to a loan portfolio, but really this is a methodology that we've been thinking about that could apply to many different types of environmental stress on commercial loans. And so we imagine that this framework could be adaptable in future. But what we think about is starting off with drought hazard, and this is a detailed representation of the amount of precipitation that happens in a stress scenario in different parts of the world. And then we have a component that translates that hazard into the impact on a business. So this is not on the bank business, but on the underlying business that the loan is written for. And so be thinking about what impact that has on that kind of organization. There's also a second point, which is if the drought is severe enough, it could have significant macroeconomic effects. So if lots of companies are ceasing to produce, or there's significant impact on the cost of raw materials, etc., that impact could be borne out in overall production, especially in more extreme droughts, the kind that are sort of in the 1 in 200 year kind of degree of extremity. So our plan to make use of this structure is, imagine we have a loan to a company, and we have some information about that company's operations. So say it's in farming or in agriculture, we can make use of what that company does to estimate what the revenue and cost impact of a drought would be. So in this case, production might fall because there's less available rainfall for the crops to grow. So that's one kind of example. So that would be where the vulnerability model fits into this work stream. But then there's another component to this that we need to think about, which is ultimately what makes the company default on a loan. And to build that in, we need to consider what information is contained in the company's financial statements, or what information do we know about that company's credit quality. And so we have these two separate streams at first. The macroeconomic model, in some of the bank's own stress testing models, may automatically influence some of the financial statements and credit quality indicators that are used for different industries. So that will be factored into that at the earliest phase. But then the next phase is to factor also the company operations impact into those company financial statements. So directly from what happens to the company's assets and how productive they are, we're able to apply that to what the company's financial statements are in order to get to some new indicators of credit quality. And that will give us a method for coming up with a set of probabilities that define by industry sector how likely it is for different loans of different credit quality to migrate to a new credit quality under the drought stress scenario. And as I say, this thinking we believe could be applied to other kinds of environmental stress as well. So we also, this is just looking at one company, so then the next stage is to be able to aggregate this over lots of different types of loans. So ultimately putting in your distribution of the loans in terms of the proportion of exposure by credit quality, plugging that into this tool, it should output the expected loss as a result of the drought hazard when you extract the information at the end. Now I'm going to give a few previews on what we've been seeing in the early phases of this research, because this project's sort of been going for approximately a month now. Now I'll start off by talking a little bit about the drought hazard itself. Now, here I show a time series of a measure of drought that's pretty well established in academia called the Standardized Precipitation Index. Now, this is how much below average precipitation over a predefined rolling window time horizon there has been. So the degree to which the precipitation has been below average. It's usually followed by a number, so SPI something, in this case it says 36. So that is the number of months that we're looking over for a period of drought. So SPI 1 would be 1 month droughts over the long time. In this case, we're looking at 3 years. Now, in the examples shown here, at a national level, the most severe 3-year droughts can be seen over the time period of 1900 to today as the deep troughs in this time series. And we show this for China, and you can see that these lengthy droughts happen to coincide with some pretty major catastrophic events in history that have occurred in China, which represent the 2 famines around the middle of the last century. So it's already clear that there's some information in this. Excuse me. But this is one aspect of what we need to consider in this problem, and we'll find that meteorology and precipitation are really only a sort of part of it. Okay, so what other things do we need to consider? I mentioned the length of a drought. Well, its length and its geographic scope may differently impact businesses with different water dependence. So if we take agriculture as an example, in the Midwest of the US, we have quite a heavy reliance on rainfall for crops, whereas in California, it's typical that agriculture uses more piped water and irrigation. Now, 6-month drought, depending on when it starts, could be pretty damaging in the Midwest for crop production, whereas in California, the irrigation and wells and piped water are more sensitive to basin level effects, which is not just the rainfall, but the way the water flows into catchments.
Hi, Dom, sorry. Just we're running a bit, we're going to start running over time, sure. So if you could just keep it to another 1 or 2 minutes.
Yeah, that's fine. Yeah. This tends to manifest itself over a longer time. So what I'm getting at is in different areas, we'll have different types of drought being important. That's something that we'll need to think about, given that we only have a few scenarios per country, and that's something that we're looking at the moment. Finally, I'll just say that we want to quantify the impact on a firm. So when we consider the types of drought impact on a company, there are direct and indirect impacts. There could be other companies in the supply chain, other industries that are significantly impacted by a drought, and that could influence the cost of power, the availability of raw materials, etc. And that impact is going to be important in calculating the impact of the drought on a company. And so we're trying to factor those things in by looking at those downstream indirect effects and how those could influence the cost and the revenue that company produces. That's it from me. I'll hand back to Liesel now.
Thanks very much, Tom. So we'll be having workshops on this over the next month with the banks involved in the project, and we'll give an update a little bit later on this year on where things get to. So I'll hand over now to Vanessa Evans. But Vanessa, I'm just going to get your slides up. If you could unmute yourself as well. I think you're on mute at the moment.
Hello, thank you, Liesel.
So as you know, the NCD has been doing mostly work on risk, and this is around a scoping study on the opportunity side. Go ahead, Vanessa.
Thank you, Liesel. So the aim of this scoping study under Working Group 2 is to evaluate emerging methodologies and approaches to integrate natural capital factors into financial products and services, to identify challenges and barriers, and also to provide recommendations for potential NCD pilot projects. So for the purpose of this study, we define natural capital financing opportunities as activities that provide financial institutions with access to participate in development and or creation of assets and revenue streams that aim to conserve and or reproduce natural capital, as well as opportunities to finance activities that sustainably recognize, manage, and incorporate natural capital assets in corporate business operations. So we're not just looking at conservation finance, we're also looking at mainstream natural capital financing. So this study, the research for this study started in July 2015 and is currently ongoing. We have a third version of the draft, and it should be going out for stakeholder consultation in April, May. So this study was financed by the Moore Foundation. And I'm going to share some preliminary findings. Next slide, please. So the study showed that the finance sector is actively considering natural capital in its products and internal policies. 97% of respondents highlighted considering natural capital in existing financial products and services, while 91% of respondents highlighted considering natural capital in the design of new financial products and services. However, while the majority of respondents informed that the need to actively manage risk as well as explore opportunities in natural capital financing were considered equally important drivers in the business strategies within their organizations, only a minority had an exclusive internal policy on natural capital financing. Next slide, please. So now looking at natural capital themes that are prioritized for financing. 78% of respondents highlighted prioritizing financing opportunities in the water and agriculture sector. Across the spectrum of financial institutions, these range from financing activities related to water and agricultural infrastructure and the production of provisioning services to watershed management, land restoration, and soil fertility conservation, for example, for more impact investment-focused organizations. However, the interest of respondents in financing marine ecosystem and fisheries was surprisingly quite low. Next slide, please. So evidence suggests that the finance sector is already offering a wide array of products and services to facilitate the financing of natural capital opportunities. However, the scope and geographical coverage is fairly limited. It's far from being global and mainstream. So a majority of respondents offered at least one natural capital linked product, service or transaction, which varied significantly in size, scope and geographical coverage. Funds and financing facilities, for example, which were the most popular structure to carry out funding or investments into natural capital, our broader sustainability funds used for capital allocation into public equity or indices, mostly within developed country capital markets. On the other hand, DFI and impact investors tended to offer more dedicated financing facilities or funds for natural capital activities, mainly country or region specific and focused on conservation. Next slide, please. So finally, a majority of respondents acknowledge that even though the finance sector has begun to consider natural capital financing, the progress has been far from ideal, with substantial barriers remaining to scale up natural capital financing. So the barriers considered by the respondents as being the most detrimental to mainstreaming natural capital financing, where the lack of enabling public policy and governance structure in natural capital, a lack of available information on investable opportunity, an absence of common global metrics and methodologies to value and develop scalable products and services for natural capital financing, an inherent lack of awareness on natural capital impact and dependencies, and subsequently low demand for financial products and services amongst asset owners and capital suppliers. Next slide, please. So finally, I just want to quickly run through some of the work that FFI has been involved with linked to natural capital financing. So we've developed a toolkit for sustainable seafood financing along with WWF Netherlands and the North Sea Foundation. It can be used by mainstream investors and credit lenders to assess their risk exposure, but also be used to assess and rank the sustainability of investment opportunities. We are also supporting ADM Capital in developing a tropical landscape impact bond. We are part of a consortium of NGOs looking at developing green bond metrics and to assess the greenness of green bond. And we are doing research on how Islamic finance can be channeled towards natural capital in Indonesia and Malaysia. So thank you very much.
Thanks, Vanessa. So the study is still in the initial findings phase, and we'll be working on it some more and showing it for consultation over the next few months. So now we'll hear from Fabian Huwyler at Credit Suisse, who's been doing some pioneering work around conservation finance. Fabian, I'm just getting your presentation up. Go ahead, please.
Thank you, Liesel. And thank you for providing me with this opportunity to talk about the emerging field of conservation finance. I'd like to talk about two things today. First, I'd like to dedicate some time. I hear an echo. Just try to. Can you hear me now?
Yes, we can hear you. Except now we can't hear you. I think you're on mute now, Fabian.
Can you hear me now?
Yes, we can hear you.
Okay, great. So again, I'd like to talk about two things quickly about the global market potential of conservation finance, and then about some of the key findings of our most recent research report, which we really developed with the objective to identify financial product structures that have the potential to establish conservation finance in mainstream investment markets. So if you can move to the next slide, please. I'd like to start with a chart that we worked on for our first report in 2014, and this chart conveys three key messages. So the first one is that the best estimates are that about $50 billion per year flow to conservation projects, the bulk of it in public funds, and market-based activity only generates about 20% of the total, or approximately 10 billion. The second message is, and that's what you see on the bar on the right-hand side, is that approximately 300 to 400 billion per year are needed to meet the global conservation needs. And this brings me to the third message. So we have around 50 billion of funding now, and we need around 300 to 400 billion per year. And to meet that global need for conservation finance with market-based mechanisms, we estimate that the investable cash flows from conservation projects need to be at least 20 to 30 times greater than they are today. What is also clear is that in the current market environment, increases in government philanthropic funding are likely to be modest, if at all. So the mobilization of private capital will be essential to close this funding gap. What I think the good news is that there is no shortage of funding from the private sector. Quite the opposite. We believe there is an overall potential that is very large, and we also believe that with a focused effort, such investment opportunities in natural capital or conservation issues can become very viable and attractive to mainstream investors. So if you can move to the next slide. With that in mind, we focused in our new report on the holy grail question in banking, and that is this sector scalable? And if so, how can we get it to scale? And for this new report, which we officially launched at a conservation finance conference in New York on January 21, we collaborated again with McKinsey, and we were also fortunate to have IUCN, the Gordon Betty Moore Foundation, and the Rockefeller Foundation on board, which are some of the biggest funders of conservation work globally, and who agreed to help us set the direction of the report. So in terms of the objectives, the key goal was really to identify financial product structures that have the potential to establish conservation finance in mainstream investment markets. And this was really based on the approach that we think investors will need to play a crucial role in this current phase of market expansion. At the same time, we certainly hope that the report will also help conservation project developers, NGOs, better understand the possible funding options available to them by the private sector. So if you move to the next slide. With that said, in order to be able to identify product structures that have the potential to, again, establish this new field in mainstream investment market, we started the project with analyzing both sides of the conservation finance equation. So that's on the one hand, on the left-hand side, typical conservation and restoration projects, their cash flow patterns, their risks, and more generally their operational characteristics. And then on the other hand, we looked at a broad range of institutional and high net worth investors. We analyzed their investment preferences and how to match these preferences with financial product structures that could meet their requirements. And in a nutshell, the simple statement of the chart is financial products are bridging project funding needs and investor interests in the conservation finance space. And we really think the chart illustrates this vital link between the project and the financial demand side and the investor or the financial supply side. And the challenge now lies in developing financial vehicles that meet both the project developers and the investor requirements. And that's what I want to talk about on the next slide. So the conclusion of the report has been that a successful mainstream product might be the most important next step for the growth of the conservation investment field. We think that simple and large-scale mainstream investment products will be the catalyst for exponential growth of this conservation finance market. And really the significance of these products lies in introducing the viability and also potential scaling of conservation investments to a level where they are of interest to the broadest set of investors, especially to those investors seeking investment opportunities with longer maturity and weak correlation to mainstream investment markets. And once the market is comfortable with that general notion of the field and its investability, we think that less mature structures in conservation areas may find fertile soil to grow. So based on some of the expert sessions that we had with project developers and investors, we have identified a few examples of structures with mainstream investment potential. First, we think that such mainstream products should leverage conservation markets that are sufficiently mature and have reached the scale necessary to absorb larger investment volumes. And based on available market data, such sectors would be sustainable forestry, sustainable agriculture, and ecotourism. Second, we think that mainstream products need to avail themselves with financing sources that are available on a large scale. And really, if you look at the impact investing landscape, mature debt and equity investments are most likely to yield this volume of financing required for a mainstream investment product. And last but not least, mainstream product structures should be easy to understand, they should be versatile, and they should be scalable. And this particular criteria seems to be met by simple bond and fund structures. So looking at global investment potential estimations in the report, we really think that our underlying assumptions have been proven by the fact that the highest investment potential for mainstream products lies in the mature project and mature financing quadrant that you see on that slide. And in order to grow the conservation investment market to scale, it will be critical to develop and package investment proposals that both provide a market rate financial return and leverage multiple sources of finance to reduce risk and maximize impact. And again, going back to the budget limitations that we see in a number of countries, developed and developing, we think that new and innovative investment solutions such as these that we find in conservation finance are required to close that financing gap in the conservation, in the management of conservation areas. So with that said, I will close my remarks and happy to take any questions.
Thanks very much, Fabian. So I know we're already at time, but if you have any questions, just raise your hand or put it in the question box. And otherwise, of course, we could follow up afterwards. And if you email me, we can put you in touch with Fabian or any of the other speakers if you have any questions, or of course, suggestions or comments on any of the work that we're doing. So I can't see any questions at the moment. I think given time, then it's better if you could follow up. And I'd just like to thank all of our speakers today for today's webinar, and also for those who've joined. Thank you very much. That concludes today's NCD webinar.
Thanks.
Thank you.